Thank you also to James Hay, Alistair Conway and team. Thanks for having us here today. Congratulations, by the way, on this 40 years of expertise. 1979, the same year, in fact, that T.Rowe Price opened its office here in London. So I think we have a little of commonality on this 40-year anniversary we're celebrating here today. So US equities. So let's just start off with this. So for those that don't know T.Rowe Price, and I'm maybe assuming some do, some don't, I just want to give you a little sort of flavor as to exactly who we are. So we're a large, active asset manager, one of the largest active asset managers in the world. And we own a top five active position in all of these companies, which hopefully you'll recognize quite a few on there. So I'm here to talk about US equities. So US equities, we know the US is the most efficient market in the world. And I guess that makes it a place where it's really, really hard to outperform. And the whole active-passive debate in the US has probably been most keenly felt in the US market versus almost any other market out there. So actually, uncertainty ahead. We like uncertainty. Now, is the guy on the stage crazy? We like uncertainty because uncertainty presents inefficiency in the market. And we're all about picking individual stocks. So if there's uncertainty about a particular stock, we like that because that represents an opportunity for us to work and to understand what the key drivers are for that stock idea. So I just listed a few ideas here, a few things that we look for when we look at buying stocks in the US. Unique insights. Maybe that's really obvious. We owned a position in PayPal the day they announced a deal with Visa MasterCard. The stock went down because there's an expectation that there'd be a growth at a lower level of profitability. Market sold it down 15%. We thought actually, well, the terminal value of this company has actually improved because you don't have these two 800-pound gorillas on the other side of the table going to be a competitor of yours in the next 10 years. So the risk of terminal value actually declines. Stock is now up more like 2.5 times since that initial sell-off. So having those unique insights, I think, are really, really powerful to understand what the drivers are to valuation. Rate and duration of growth. I think rate is actually pretty well understood. If you think a company is going to grow 40%, the market thinks 20%, you win because you have a better view of what that growth rate looks like. I think that's pretty evident in large cap growth. What's a little less well understood, I guess, is the duration of growth. And I'll talk about this in a slide a little later. But really understanding those companies that can genuinely compound growth over a long duration of time can actually be really, really powerful performers to your portfolio. Identify disruption. Why is that important? Again, because that creates a level of uncertainty that is something that you want to exploit and profit from. Accept change. At our view at T. Rowe Price, we think about 30% of the S&P 500 is secularly challenged. So why is that important? Well, it's important because if you think about if you're investing in an active and a passive, if you take a passive vehicle, on our estimations, you're already assuming that 30% of that position is going to be secularly challenged. It's our job to try and find those companies that can genuinely survive and thrive going forward. So we have to accept that that's happening. Business model innovation. So if you think about Microsoft had to accept change. For 10 years, Microsoft was a value company. A value company because actually nobody was buying PCs. Growth in PCs was declining. Why? Mobile phones. People weren't buying PCs anymore. So if you have a business tied into that PC cycle, as Microsoft did, then that is a secularly challenged business. Now, the good news is they accepted that change. And what did they do about it? Well, when Nadella comes along to run that business, they start off by introducing Office 365. They go into web services businesses. They diversify and innovate their business to adapt to that changed environment. So for 10 years, Microsoft was in the doghouse. In my opinion, it was a value company for 10 years. Now it's back to a growth company because they adapt their business model. Product innovation. I'll just mention two things in here. So Boeing is a name that we own, as we used to own Tesla. Really different products. What's different about a Boeing plane? Well, they make a plastic plane. 787 made out of plastic, laminated plastic. Why is that important? It's really fuel efficient. So if you come to market with a different product, a better product, that again is something you need to pay attention to. And then real uncertainty. I'll go back to Tesla for a second. And I know Tesla is an idea that will sort of split the room in half. You know, there'll be believers and non-believers. But where you make the real money in Tesla is when there are those existential questions being asked. Is, can you build a car that's electric? Can you build one that's going to have a range? Can you build it at scale? Can you build it with free cash flow? And all of those questions existed when that stock was $80. Fast forward, it goes to 300. So you made the money when all of those existential questions are getting asked. Is this actually possible? From here, I think the questions are far harder, far more nuanced. We sold our position in the first quarter, so we took our position down by 90%. Because the questions at this point get a lot harder. And that question right now is, what exactly does the demand look like for that product? So really, hopefully that gives you a sense of the different varying things we're looking for in the portfolios as you think about sort of investing in US equities. And I'll just go through a few little examples here. Well, should the clock be on, by the way, just to check I'm on time? Thank you. Thank you very much. Okay, so I mentioned these companies about duration of growth. And so we put on this slide power compounders. So let's look at a little example. So a company like Sempra Energy. I don't know how many people follow Donald Trump's Twitter account. I guess we all should, just in case whatever comes out next. 3 weeks ago, he's standing on top of a liquefied natural gas terminal in the US. Now, I kind of cheekily put a little canoe on here. Export capacity in liquefied natural gas in 2015, you could have piled it all into a canoe. Zero. Nothing. Today, 2018, 3.6 billion cubic feet, and this 10 billion cubic feet is stuff that's already now under construction. So all of a sudden, the US is now turning from not being able to export liquefied natural gas into this growth area, which we think has duration. So why does it have duration? Well, if you're Germany, you're petrified that the Russians are going to shut off your gas. You're petrified. If you're China, you're importing it from Qatar and from Australia. You know what? You want to have and China are obviously the largest energy importers in the world. They want to be sort of second, third, fourth, fifth sourced on important energy. So now the US, through technological improvements in shale gas production, are now able to have this nascent industry, which back in 2015 was zero. And now it's going to be, we think, a very decent growing business for Sempra Energy. Another power compounder, so we own a utility company. We like utility company in a growth portfolio. Like, when would that ever make sense? And we own a company called American Water Works. So, mercury in the water in Michigan is not a good headline because it kills people. So 35 years worth of underinvestment in municipal waterworks, we think that's a great opportunity. And maybe I see there's an infrastructure speaker a little later. But that for us is a really nice long-term growth idea, excuse me, a long-term growth idea in the space in utilities. So not a natural for people to expect that would be something that a growth investor would look for in the US, but that's what we do. So moving on to tech, no presentation about US growth would be right unless you talked a bit about tech. So I think one of the biggest, most powerful drivers here in the US is a switch into variable costs away from fixed costs. And I just want to give you a little example as to what this means, because people talk about infrastructure as a service, platform as a service, and software as a service. So I'm just going to sort of break it down a little bit. So I'm assuming most people in the room have possibly at some point owned a car. So your car sits 90% of the time idle. 10% gets driven around. So this is kind of like the tech sort of analogy. So you can choose to buy your car, have it sitting around idle for 90% of the time, or you can decide that when you want a car, you can rent it. So rent it is infrastructure as a service. You decide where to drive it, you put the fuel in, but you leave somebody else to maintain the brakes and maintain the sort of the wellness of the car. Platform as a service, that's like taking a taxi. You've given away some of that responsibility to somebody else. They're going to take you to destination, but they're responsible for putting the fuel in and insuring it and changing the tires and all those sorts of things. And then finally, software as a service. It's like taking the bus. So taking the bus, it's a preordained route. You get there, and you sort of hand yourself to somebody else who's going to look after you all the way from start to finish. And that is all of those three is a $300 billion total addressable market. It's an enormous market, and you can see these growth rates, which are all pretty compelling. Whenever I think about software as a service, I have to just share something with you. I think about my dog. Now that might be a bit of a strange segue, but my children begged me to get a dog. And they promised me they'd walk it. Well, they lied to me. No great shocker in that. They lied to me. And so what we had to do, we basically had to go out and hire a dog walker. And so Maddie, the dog walker, turns up to the house 3 times a week, takes our little dog for a walk out to the park and back, all very good. And then Maddie would send me an email at the end of every month saying, you owe me £150 for walking your dog. If anybody's interested, by the way, there's an opportunity for any competing bids in Wandsworth. So £150 per month, she'd send me this email. Now, then all of a sudden, what I got from Maddie, the dog walker, instead of getting an email where she'd chase me for this, if I forgot to pay, she'd have to resend the email and chase me. Well, now she uses something called Intuit. So Intuit has a product called QuickBook Online. So for £8 a month, I now get an automated email from QuickBook Online chasing me for the receivables, or her receivables. So all of a sudden, she's now adopted a software package, literally a one-woman, one-dog business. And even this democratizes software to the extent that it works for her. And again, this is, a huge total addressable market, which has all of a sudden just been opened up. Otherwise, you'd be like sending emails and chasing emails, and Maddie can spend more time, hopefully, walking my dog and others, as opposed to like sending out emails chasing money. So that, I think, is actually really, really powerful. So why do we like a business like Intuit? So it leverages an existing expertise that they've already got. The actual cost to deliver this to the end customer is actually, well, pretty much zero. And it's got a huge, high return on invested capital. So that's why we like it. I mean, I hope I've shared you a nice little story about my dog walking exploits, but really the reason why we own it is that it gives you a large addressable market and very, very high returns on invested capital. And that's why we like things like software as a service. So e-commerce, I think everybody's familiar with e-commerce, eating the world. And I'm not going to, I guess not going to talk necessarily too much about Amazon in this part. But it's assumed, of course, that high street retail is like roadkill. I was listening on the radio this morning. Arcadia is talking to its landlords about whether they can reduce rents, for example. Over the last 5 years, major department stores in the US are down between 50 and 90%. JCPenney is down 90% in the last 5 years. So generally accepted that anything in retail looks like roadkill. Well, not so fast. As an active manager, you go in and you look and say, okay, what's really happening in here? So we looked and looked for ideas that would maybe not actually be roadkill. So we looked at a company called Ross Stores. Now, Ross Stores, those that haven't been to the States, it's like a Calvin Klein boxer short treasure hunt. So you go to this big warehouse of a store and you look around for these kinds of items. That's actually really, really hard to do on the internet. That stock the last 5 years is up 200%. Dollar General, average basket size like $7. Really, really hard to do on the internet. It's actually very easy to buy things on the internet. It's actually very, very hard to shop on the internet. And so Dollar General, up 130% in the last 5 years. So let's not assume this is happening, absolutely. So 20% growth in e-commerce, that's absolutely happening. But there are tremendous opportunities. There are sort of secondary effects in here that are really worth paying attention to. And that's why I want to include it here on the slide for you guys today. So now I have to mention Amazon a bit. So advertising. So this just shows a few sort of metrics as to advertising growth in some of these companies that happened in the last 5 years. And Facebook has been a huge advertising growth company. Now, the reason I put Amazon in here is advertising is really the third leg of Amazon's, advertising is the third leg of Amazon's business. We know about e-commerce. We've already talked about web services. This one is now advertising. So why does that make sense? So if you look on Amazon and you look up for AA batteries, Duracell AA batteries, you could be presented with a whole page of Energizer batteries, or I saw yesterday before I came out to do this presentation, GP batteries from Hong Kong. I mean, I never knew there was a place called GP batteries, but apparently there's a place called GP batteries. So they advertise. So they pay Amazon for points of presence and points of prominence on the website. And because it is such a shorter distance, such a click away from seeing an advert to purchasing something, you can actually measure really, really accurately how much you spend versus how much you sell as an advertiser. And so that's got a really, really powerful ROIC connection to it. And we look at the business of Amazon, about a third of its value we think is going to be coming from the advertising business as we go forward from here. So it's still I know there's a lot of controversy around the growth and the prominence of certain large internet companies in advertising, but it actually is genuinely competitive, and Amazon is coming in disrupting the original disruptors in that marketplace. So healthcare. Healthcare has been actually a really rich vein of performance opportunity in the US market, highly innovative. I guess this really just goes to show something on the right here. That's a Da Vinci robotic surgery piece of equipment. It's a company that we own 10% of, so we know this company really, really well. Procedure growth is increasing, unit growth is increasing, and that's actually been, I guess, it's a bit of an anomaly, I guess, in healthcare. It's actually a high growth company that exists in healthcare. Most of healthcare isn't high growth, to be fair. The largest drug in the history of the world is $16 billion. And some large cap companies add that in revenues in a single year. So normally healthcare is like a compounding growth area, but there are areas where you can see dynamic growth. And we just put on here, had you decided over the last 3 years to buy equipment and supplies, you'd be up 82%. Had you decided that biotech for the last 5 years, the last 3 years is the place to be, you'd be down 6%. So healthcare is not just one thing, not one item. It's a whole set of heterogeneous pieces of the market which makes up that sector. So I just have to talk a little bit about FANG and its contribution. I think whenever I talk about US large cap growth, people say, well, it's all about the FANG stocks. Yeah, that's kind of why things have done well in US growth. So we looked at data and said, okay, so let's look at the Russell 1000 growth. And over the last 5 years, 26% of the performance of that benchmark came from these FANG stocks. So that's a pretty significant. 2015 was a pretty big year in terms of contribution performance. For T.Rowe price, so just for sake of completeness, we've been invested in these companies too. I showed on that first slide where we're top holders. So it's been a 34% contribution to the overall advancement in our strategies. But if you just look at kind of which companies, which are in the top 10 of those companies that contribute to that performance, only 3 of them are FANG companies. So this suggests there's other things out there in the US which can do well to get you excess returns above benchmark outside of those popular FANG companies. And we quantified it. So if we think about the alpha we've generated over the last 5 years, and by the way, we actually did generate alpha. That's a rare thing, I guess, in the US equity market, but we've generated alpha over the last 5 years, net of fee. 62% of it came from outside of FANG stocks. And so this talks to some of those other things we've been going through in this presentation. But there are other things, there are other opportunities in the US market, apart from those that I guess grab the headlines. And just finishing here, this is Trusty the Sheep. It is T.Rowe's emblem. It's about being sort of sure-footed in sort of rocky conditions, which is probably pretty appropriate for almost any market that I can think of. And then on the left side, it just shows the performance numbers of the last 5 years. So S&P's done well. S&P's up 10.9% over the last 5 years. So that's up 50%. So the US market is up 50%. We've done a little better than that. And over that cumulative time period, that's more like 98%. So active managers do have a role if they can execute properly and can demonstrate that through performance net of fee. So I'm now coming up to my 10 minutes where I would like to engage with you guys as to what your thoughts or comments are, and if I can answer any questions. So Damien, is there any questions to be had?
Don't believe we have any questions as yet. If you want to use Slido to ask any questions, please do. We have a question. Sorry. It's behind you.
Valuation of the market. Thank you. Thank you for that question. Hopefully, can I flick this forward? I had to come with a valuation slide because somebody was going to ask me about valuation. I get it. Right. Okay, this hopefully comes across better in your packs if you have a hard copy. There are little dots on this slide. I don't know whether they're not on here. So valuation is actually pretty much in line on a price earnings basis with 20-year averages. The exception to that is on Russell 2000 growth, where we are running a little bit hotter versus long-term average. So we're not here in sort of like super extended territory. Just to sort of put that into a bit of context, people talk about sort of Russell growth and value. And I'll just mention this one first, this one. So this is the US versus other markets in the world. And this goes from 2009 financial crisis to today. So the US S&P is up 417%. So that's a pretty good performance, outperformed every other stock market in the world. Now, why? Well, if you look at on the right side, that's trailing EPS performance. So the US has actually had the best earnings growth of any market in the world. So let's not be too let's not get too, you're confused by the US market is up a lot because the valuation's gone up a lot. The US market has gone up a lot because actually there's been very good core performance that's coming out of this market. So earnings growth has been good. I was going to go just back to this slide because people ask me about growth and value, so maybe I've just stolen somebody else's question. I apologize. But growth value is something I get asked a lot about when I meet with clients. And this sort of shows growth on the one side, on the left, and value on the right. And it breaks those components down into various components. So the green part here, where's this? No, it doesn't. Okay, the green part here is really earnings improvement. So the majority of the growth company's performance has been actually as a consequence of earnings. The light gray bars are actually, a deviation or change in actual valuation. So what has actually driven most of this improvement in the performance in growth stocks has actually been an improvement in earnings. So this isn't sort of, we're not in sort of, we're not like Wile E. Coyote, like we haven't run off the edge of the cliff and there's nothing there. We've actually got a pretty stable base of earnings to justify where we are at this moment in time. Oh, okay, I'll see in here. Can you comment on the pros and cons of taking a GBP hedge position in US equities? Honestly, that's a tough one. I guess I'm standing up as the US expert. I think the UK's got its own particular challenges right now regarding sterling. So I'm going to have to sort of take a bit of a flyer on that one. In terms of, I guess I don't really see if you invest in the US market, I guess you have to accept there's a degree of foreign exchange currency exposure. Over the last 10 years, that would have actually served you extraordinarily well because the sterling has been a bit of a basket case. So I guess I don't sit. Unfortunately, I don't have to. I guess maybe fortunately for me, I don't need to sit in your shoes to sort of make those decisions to your clients about, do we sit in here in hedge class or not hedge class. We do offer a hedge class. That's a product which is available. But I think you have to take a view on sort of UK sterling. I think UK sterling is probably the bigger question as opposed to whether or not the dollar is going to weaken versus sterling. It's more of a sterling question, whether it's actually going to strengthen relative to other currencies in the world. Comment on the US-China trade war. That's a short one. US-China trade war. Well, I guess just because somebody signs a piece of paper doesn't make it so. That would be my first observation. So don't expect. There'll be a big fanfare. I'm sure there'll be lots of tweets. There'll be a big fanfare about actually signing a piece of paper at some point in time. Now, the biggest question mark around that is what is the compliance to what's been agreed on, and don't be too shocked if further down the line you get what I describe as like a snapback tariff. If the US is not convinced that China are not respecting intellectual property rights, then expect to see a snapback tariff come in from the US to try and get the Chinese back on side. And obviously, I'm saying that from a US perspective. I think it creates a lot of uncertainty, certainly. We've tried to quantify it in terms of GDP impact. We think it's about a 20 basis point drag to Q2 and Q3 US GDP growth. US GDP Q1 was 3.2%, actually a really, really solid number. I think Germany's about 40 basis points. China is decelerating, trying to re-stimulate. And I think it's going to weigh on the market for a long time to come. And even the Chinese are kind of sitting there possibly hoping that Trump's not going to get re-elected and they can go back to what they were doing previously. And you look at Joe Biden. Joe Biden is far more of a dove regarding tariffs, I guess using that as a kind of a weapon of negotiation. So I guess watch this space. I think it's still going to be a very rocky road as we go forward. I think Donald Trump, for all of his personal failings and criticisms, he's the first president that's actually stood up and said, look, we need to fix this. We need to change it. We need to make sure that the US companies aren't basically ceding intellectual property for free. You can buy it. If you want to pay for it, you can buy it. But if you don't want to pay for it, don't steal it. And I guess that's the first president that's actually done that to stand up to the Chinese. Are the plastic planes causing Boeing's a problem? Easy one, no. Not currently. Touch wood. 737 is still traditionally made out of metal, and that's the one they've had a problem, the 737 MAX. The 787 is the one that's made out of plastic, and they're getting smarter at building it, so it's costing them less to build each individual plane, and they've raised price by 25% since they've launched it. So costs down, price up, huge free cash flow inversion for Boeing on that product. How sensitive is your fund to US rates? Actually, not so sensitive. I guess ultimately everything's sensitive to US rates, I guess. We're very small about part of our fund is exposed to bank financials, where this would just sort of most keenly be felt. And if the US large cap growth index, the Russell 1000 growth is about 4% of the benchmark. So I guess we are relatively, I'd say, a value strategy be far more exposed than growth strategy to US rates. Predictions for timescale for current US growth. Well, we're currently at 3.2. That's widely expected to decelerate to 2%. If this is a question about, well, I guess another way to ask, when's the next recession? I don't think I can show you any great expertise at calling the next US recession any better than anybody else. Right now, we don't see it. So if we look at 2019, 2020, right now we don't see a recession coming. We of course could be wrong, and we make plenty of mistakes. So we're only human. But in terms of predicting when that recession is going to happen, that's really, really hard to do that with any kind of accuracy. We think beyond sort of 18 months, 2 years out. Are you anticipating changes of favorable tax rules introduced by President Trump? Not unless he doesn't get re-elected. If he gets re-elected, then they stay. It's actually pretty transformational what they did here. So 10 years worth of tax cuts, which makes it a real policy. It doesn't give them an advantaged position relative to the rest of the world, by the way. It just puts them in line with the rest of the world. So they are now actually being able to compete on a like-for-like basis, which I actually think, personally, is actually a good thing. So I think that's actually something that Trump has done. I think that should be applauded. Have Trump's taxation reforms benefited the Dow and S&P Jones? S&P, do you expect this level to level out soon? What's really funny about tax is, we look at individual companies, and so we try to figure out not necessarily like who's going to see a tax rate go from 30% down to 20%, and therefore buy those companies that see a lower tax rate. What we're more interested about is who actually gets to keep the money. So if you're like a Boeing, let's use that as the example. If you're number one in a global duopoly, and you're presented with a tax cut to your business, what's the likelihood of you handing that back to your customers in a discount? Likelihood, 0, because you're number one in a global duopoly. If you're in a very, very competitive area of the market and you get given a tax rebate, guess what you do? You give it back to your customers in price. So how much of that do you get to keep? Nothing. So we want to avoid those second set of companies where they're going to be giving up the benefits of the tax reform, and we want to be owning those that can actually get to keep those free cash flows from the instance of lower taxes. So I think it's a very stock by stock individual process you have to go through to figure out who exactly is going to be benefiting from tax and who doesn't, and that obviously then all, I guess, percolates up to performance within the market. So I guess we spend more time worrying about stocks within the market as opposed to worrying about the market. Do you think the US government will try to break up big tech companies like Facebook and Amazon? Well, we don't think so. Currently, we don't think so. So the DOJ and the FTC have kind of split out. They've kind of divided and conquered, or they're dividing, hoping to conquer, which body is going for which set of companies. And when we look at the evidence, the Department of Justice has probably been more vocal so far. Don't forget the FTC already did a review of Alphabet for 10 years and basically found nothing wrong. The DOJ have now taken on Alphabet onto their docket and sort of are now going to be chasing Alphabet. So we actually think reassuringly, all of these things ultimately have to come to a court of law. So no matter how politicized the DOJ is becoming, when we think it's actually getting pretty sort of highly charged politically as an organization, you still have to present evidence to a court. And actually presenting evidence to a court that you have abused your position to the detriment of consumers, that's actually really, really hard to actually prove. Because guess what? You get Google Maps for free, you get Gmail for free, you get YouTube for free. And so it's really, really hard to say that we're worse off in that respect. And so I think it's when you actually come to the evidence that's going to be presented, there's going to be lots of noise, so don't get me wrong, there'll be lots of noise, but when you actually have to present the evidence to a court, we're actually encouraged that actual sort of cool heads will prevail, and that the evidence is not sufficient to justify breaking these companies up under the current legislation. So what does it take to do this? And I'm running out of time. You need to change the law in the US first. If you really want to be serious about breaking these companies up, you need to change the current rules, because the current rules do not put you in a position to break these companies up. And so, we think that it'll still sort of add, a certain amount of risk premium to those stocks in the medium term. But unless you change the law, we don't think there's a high likelihood of that happening. David, thank you very much. And thanks everybody for your time today. Have a good day. Thank you very much.